You're listening to Fund Shack. I'm Ross Butler, and today my guest is Arjun Raghavan, Global CEO of Partners Capital. Partners Capital was founded in 2001 to provide investment management services to long-term oriented, endowment-style portfolio owners. Arjun joined the business in 2007. He was responsible for portfolio construction. Then he went out to Asia to set up their operations in Hong Kong and Singapore. And then he came back to London to become CEO in 2020 and is here with me now. Arjun, welcome to Fund Shack. I really wanted to interview you because I looked on your website, and the fascinating thing is that you manage money, or Partners Capital manages money for a lot of private equity executives themselves. And so you're almost like a meta private equity executive. And I just thought, what kind of person does a private equity person trust with their money? And the answer is you. So I'd love to talk a little bit about that. But first, maybe tell us what Partners Capital does.
Yeah. Well, firstly, thank you for having me, Ross. Great to be here. Looking forward to this conversation. So the origins of Partners Capital are a little bit unusual, as you mentioned. We were set up about 22 years ago by our two founders, Stan Miranda and Paul Dimitrick, who really came from being affiliated with the private equity world. And so their idea at that point, when we set up Partners Capital, was really to work out if they could take sort of the David Swensen Yale model, which is all about long-term investing and making sure that you're diversified across asset classes, and apply it to other owners of capital who had that similar long-term perspective. And because of their sort of networks in the private equity world, they said, well, we want to manage our money in this manner, and let's just see if our friends and people we know in the broader industry would like to do the same thing. And hence the name actually Partners Capital, because it was meant to manage the capital for the partners of private equity firms. And, to your point on, who do private equity partners trust to manage their money, our sort of original branding and the way we pitched ourselves back in the day was being the money managers to the money managers.
Got it. But you also now invest on behalf of institutions too.
Yeah. So obviously the firm's evolved quite significantly over the years. And what really happened was we started off managing money for private equity partners. And over time, we realized that actually a lot of the smaller endowments and foundations, particularly outside of the US. So if you look at sort of the Yales and Harvards of the world, they've got huge endowments. They've got big teams being able to manage a lot of the asset allocation and sort of diversifying the overall investment portfolio, et cetera, internally, right? Whereas when you look at smaller endowments and foundations, a lot of them aspired to do what David Swensen had done so successfully at Yale, but they simply didn't have the resources and the internal team to be able to do it. And therefore, we stepped in saying, well, we could do it for you because we've got sort of scale across doing this for a range of different types of clients. And therefore, we started taking on smaller endowments and foundations. And so if I fast forward to today, we've got about 60 billion of assets that we look after. And about 60% of that, 55 to 60% of that, is from smaller endowments and foundations. And when I say smaller, it usually tends to be under $4 billion or so, because once you get to about $4 billion US dollars equivalent, there's a sort of a make versus buy argument where at that point you could sort of say, well, actually, a $4 billion dollar endowment is able to hire a reasonably sized team to run that portfolio internally. Whereas under that, it tends to be quite difficult to find optimal scale, and therefore we come into play.
So you set up in 2001, which was pretty early, I'd imagine, for this. Now it's kind of an established type of service. What's the generic term?
Well, there is a generic term in the US where it's called an outsourced CIO. So the OCIO industry is sort of the industry that we're in. And by the way, we didn't know we were in that industry until this term sort of became a sort of a standard term that people started to use from 2010, 2011 onwards. Right. But it's essentially people, particularly in the US, you have a lot of endowments and foundations. There's a huge amount of wealth in the US within these endowments and foundations. And there's plenty of endowments and foundations who are sort of under 2 or 3 billion. Right? There's high school endowments, there's other educational endowments, that's sort of art and museum endowments, et cetera. And they're all reasonable in terms of size, but they all need to solve the problem that we're sort of providing solutions for. In Europe and in Asia, there are endowments and foundations as well. They're just not that many of them who've got this particular issue. But we are, some of our most important clients are in Europe. Some of them are in Asia, and a lot of them are in the US as well. And so we do this globally for a range of different types of clients.
Okay, I'd love to know about that, but let me just take it back slightly. So you've been going for nearly a quarter of a century, but if you'd come to me with your business plan and said, we're going to manage money for top private equity executives and in endowments, I'd be like, it's a bit presumptuous, isn't it? Are you sure they need you? Why do they need you?
Yeah. Look, I think it's a really good question, but I'll tell you. So what drives our business, right? So why do they need us? If you look at private equity, senior execs in private equity firms, founders of private equity firms, are essentially just too busy, right? They are, of course, they could do it. Of course, if they sat and thought about it and actually spent time doing it, they could, but they haven't got the resources and the time, right? They're time poor because they're too busy running their own business. Likewise, we look after some family wealth. And again, these entrepreneurs are just too busy running their businesses, right? And so we like to think of ourselves as sort of providing an investment office solution to them, which has absolutely no conflicts of interest, right? So that's the other key aspect of this, because what are the alternatives to these? Let's take a senior private equity a professional. What are their alternatives? They could go to private banks and they could go to other providers, right? Now, typically, banks are very good at a lot of things, but running investment programs which are entirely focused on driving long-term capital growth is one thing amongst 100 other things that banks do, right? And so to have dedicated focus in terms of exactly what we do and being on the same side of the table as our clients was essentially part and parcel of our business plan, right? So we don't have any conflicts of interest in terms of trying to invest our clients' capital into areas where for some reason it's actually beneficial to us. All we're interested in, it works for the bank or it works for a different provider.
Trying to cross-sell stuff.
We are entirely focused on what's the right long-term outcomes for the client. Right. We get paid usually management and performance fees, so we're fully aligned with the outcomes that our clients seek.
Right, so that's the private equity executive. So you cover the whole waterfront. You're a full portfolio manager. So you're investing in the things that I'd expect you to, it's like equities and bonds, but also alternatives. Do they want more alternatives given they've already got presumably huge exposure to that?
Yeah. So one important point I should make is that we are portfolio, we construct the full portfolio. We manage across all asset classes. We're focused on asset allocation and, top-down view on where the best opportunities are. But we're deploying capital for the most part through partnerships with asset managers, right? So with independent asset managers. So think of us as a manager of managers,
yes,
in terms of how we stitch together the overall folios. But we do cover the entire waterfront. So we cut across every asset class, like a classic endowment or a pension fund would do. They cover all asset classes. We would sort of do that.
Mm-hmm. So in the institutional fund investment world in private equity, people worry a lot about fees on fees, but clearly the private equity executives themselves are happy to pay you the fees. They think it's worth it.
Yeah. And so why do they do that, right? And they do that because what do they need to believe is the other way to think about it, right? They need to believe that with our access and with our focus, we're able to unearth the best investment opportunities. We're able to partner with the best asset managers globally, right? So it's one of, can we, Partners Capital, access the best opportunities across all asset classes, number one. And number two, can we do that in a way that's actually optimal from a fees perspective, right? So in other words, if you typically, because of the scale we've got, usually we get about 70 to 80 basis points back relative to, let's say that, a client went directly to particular asset managers to try and invest capital with them, they would pay 70, 80 basis points higher than what we pay, right? So we like to think that, in effect, what we do pays for itself from a pure fee perspective. And then what sits on top of that is hopefully outperformance relative to what a time-poor client could do themselves, right? Because of our selection and the ability to stitch together portfolios effectively.
What's your institutional view on asset allocation? So obviously it's not equities and bonds, it's broader than that.
Yeah. Look, I mean, maybe what we should do, Ross, is I could start with the principles of the endowment model, right? So what is the endowment model? And of course, over the last 20 years, there's been huge sort of changes in capital markets, right? And so what's needed to happen in implementing the endowment model is the other thing which I think we could talk about.
So this is to allow both smaller endowments, but also like family offices and just people with money to invest to enjoy the same investment strategy that a very long-term endowment.
Exactly.
Right. Okay.
Exactly.
So yeah, and I saw on your website you've almost branded it. It's the Advanced Endowment Approach.
Yes.
I like it. Go on, tell me.
That's what we're trying to do. Okay. Yeah. Now let me start with the original. What are the key principles of the endowment model? Right. So I boil it down to three critical principles. Right. So the first one is no market timing. Okay. So what does this mean? It means stay invested through cycles. There isn't much to gain by trying to time these cycles. So everyone's got a certain level of risk appetite, right? So once you've got your risk appetite right, put the risk in place and stick to it, right? So that's sort of number one.
It's
right?
even more than that. It's like there's actually quite a lot to lose by trying to time.
There's a lot to lose. Yeah, absolutely. And so number one, no market timing. Number two, diversification, right? So diversify across asset classes and opportunities. And the reason you diversify is to create resilience, right? And so what does that mean? It means that, yes, you could just put money in equities and bonds, but actually, I think I was looking at the stat the other day, over the last 120 years, there's been 9 episodes where just equity bond portfolios have lost real returns over a 7-10 year period, right? So over extended periods of time, while at certain points in the cycle, it looks like simple portfolios, like just equity bond portfolios, could actually do just fine. There are plenty of occasions where actually that's insufficient to create a resilient long-term investment.
How frequent was that again?
It was 9 times in the last 120 years where they've lost real returns over at least a 7-year cycle.
And that's quite a lot.
Yeah.
Yeah.
So, I mean, it depends on which part of the cycle you cash, right? And so the concept of resilience is if you create more diversification, you're just able to cater to different types of economic environments, right? And therefore, your model is just, particularly in a world where we're faced with quite a lot of uncertainty, whether you look at geopolitics, whether you look at, how AI is going to impact where we go in the world, whether you look at the fiscal deficits that are clearly mounting in every part of the developed world, you look at, there's lots of different reasons why you'd worry about the level of uncertainty in markets today. And in that sort of environment, we think diversification is your friend.
So just to pause on diversification. So yeah, it's been described as the only free lunch, but there's diversification and diversification. What's the important types of diversification for you? We're not just talking about, buying the equities market.
Yeah. Look, diversification, I think, is critically important across sectors, geographies. At the heart of it, what are you trying to do with diversification? You're trying to find different drivers of outperformance, right? So, or even just performance. So, as long as it is not fake. So, what is fake diversification is when you think you're diversified. Let's take sort of hedge funds in 2007, before the global financial crisis. Hedge funds did extremely well in the 90s, right? Because they were sort of a nascent asset class, and you sort of came into 2000 and they were starting to ramp up assets. But by the time it was 06, 07, there were a lot of hedge funds, and a lot of them, if you looked at the old asset allocation models, you'd sort of usually have a line for hedge funds saying hedge funds, and there's sort of a low correlation to equities, bonds, etc. But the reality is that they actually were very correlated with the broad markets, right? Because what they actually held were sort of very broad market exposures, etc. And so that's fake diversification, right? Because you sort of look at it and you think, actually, I've diversified because I've got a different asset class. It's got a different asset class label.
Yeah.
It must be diversifying, but actually it's not, right? So true diversification comes when the actual underlying exposures you hold are driven, they have a different sort of axis of return, right? And so we think of it as, think of it as you have to embrace different types of risk premia. For example, when you take on credit risk, you're getting paid to take on default risk, and that's correlated but different to taking on equity risk, right? Where you're sort of betting on growth typically. So those are different parts, and you can see there's a lower correlation there. It's not a zero correlation, but there's a lower correlation. And so likewise, you invest in sort of fixed income instruments, you're taking on interest rate risk, so you get paid for taking on interest rate risk. So I think you have to go back to fundamental principles and make sure that the diversification is true diversification rather than fake diversification. Right. So back to the endowment model. So principle number one, no timing. Principle number two, true diversification. Principle number three, invest with great asset managers. Right. So stitch together partnerships and put together a collection of great asset managers who are trying to generate outperformance in their asset classes, right, or in what they do. And usually you find these in boutiques, right? You find these in smaller asset managers where there's significant skin in the game, right? Where they've got the outcomes that they're trying to generate for themselves align them very firmly with investors putting capital with them.
When you say boutique asset managers, do you mean not big multi-asset managers?
Not necessarily, because it really does depend on the opportunity set, right? So perhaps I'll rephrase that and I'll say, I don't mean small. I mean focused and boutique, right? Specialist is the other, probably a good way to think about it. They could be big or small, right? So for example, if you look at certain types of strategies, you could talk about distressed investing, right? We think you need to be of reasonable scale, right? To be able to do effective distressed investing, because scale's your friend there in terms of workout teams, et cetera, et cetera. Likewise, to take a example in a different part of the world, let's take quantitative equities, right? Or quantitative hedge funds. You need scale to be able to run the models effectively and to be able to attract talent. And therefore, scale's your friend there. If you look at biotech or the lower mid-market in private equity, where we think there's actually a lot of opportunity, we think you can't be too big, right? Because you can't deploy into effective opportunities. So I think specialist is the right word. Alignment of interest is the right word. But the size will vary depending on what type of opportunity you're going after.
Got it. So they're the three
key principles, right? Now, what's happened over the last 20 years or so? Lots of things have happened, but I'll sort of point out to two key things that have really disrupted the endowment model, right? So number one, there's been a flood of capital into alternatives, right? And so we like to say alternatives have just become mainstream, right? Because it's not sort of really alternative anymore. So I think private equity, private debt, hedge funds, you add all of the alternatives together, I think it's more than $20 trillion, I think, in alternatives. And it's about 10, 15% of the global capital base, right? So now it used to be a real niche asset class where it was quite uncorrelated. You could actually sort of fish for outperformance. There was inefficiency. And it's actually become quite a big asset class, right? So question is, where do you go if you've got so much choice? And how do you know you're going to pick the ones that actually can deliver on outperformance, right? And on that theme, the other thing that's happened is, of course, the rise of passive investing. Right. And so you've got passives that have really become a huge industry. And, 20 years ago, it was a niche industry, and you could buy maybe the S&P 500 ETF, but you couldn't do much more. And therefore, when you sort of put those trends together, you're sort of saying, where do I go for outperformance? And by the way, why do I bother paying all these fees? Because maybe I can harness a lot of the diversification, a lot of what we're talking about through just a set of low cost ETFs, right? In effect, I can get the beta and maybe there isn't much alpha available, right? And so those are the challenges to the model, right? And so, so how do you respond to those challenges? We have adapted the model quite significantly, and we've talked about the Advanced Endowment Approach, but maybe I'll sort of start with, at the highest level, what we did after the global financial crisis about 10 years ago was to sort of change the asset allocation mindset to one where we started thinking about the world of investing as sort of having two separate engines, right? And so we sort of said, we came up with this concept of a twin engine plane, where you're sort of saying that the first engine is the beta engine, right? And so what is the beta engine? It's the engine where I talked about risk premia. So, and you can do it through low cost instruments, right? So go make sure your portfolio's got a different types of risk premia. You have credit in it, you have different asset classes. And you could do that in a low cost way, just pulling it all together. And that could be just fine. So if you're a small investor, you're sort of saying, look, let me just get that right.
Yeah.
That's fine.
If you're small, you can fly on one engine.
You can fly on one engine, and it's fine,
Yeah.
right? And you don't pay too much. It's not very expensive to construct that engine, and so that engine works. But if you aspire for more, you could create a second engine, which I call sort of the turbocharge engine, which is the alpha engine, right? Now, and you can separate those two decisions, right, to some extent, right? So you can sort of say, look, here's the beta engine, the alpha engine. And why do you do the alpha engine? It's not just for outperformance. Yes, you want to outperform over the long run, but the alpha engine gives you two things. One, it gives you potential better returns, right? So outperformance, but it also gives you more resilience, because a lot of what you can do with the beta engine, you don't get that extra resilience unless you go for the alpha engine. By definition, a lot of the illiquids, you can't buy an ETF for the illiquids, right? And so for illiquids, you have to go to the alpha engine, right?
You're increasing the diversification.
You're increasing exactly. You're increasing diversification. You, as part of doing that, you're harnessing potentially higher returns, and certain opportunities cannot be accessed through the beta engine, right? You can't buy an ETF, right? So if you're really sort of saying, how do I go for more resilience and potentially higher returns? You have to look to the alpha engine, right? And so the endowment model then is all about get the beta engine right, and you got to get the alpha engine right. And the advances we've made are all around how do you get this alpha engine right? Because here's an area where there's tons of capital that's gone into it. Where do you look for it? Because the danger with the alpha engine is, of course, it's expensive, right? And so if you're not careful, you'll end up, your return on investment from the alpha engine is going to be negative, right? Because you've had it all eaten up by fees. And so that's the danger of the alpha engine.
Do you manage both engines?
We manage both engines, right? So our model is to put everything together and work out how do you harness engine number one most cost effectively and in a way that's very efficient, lean, and how do we put all of the resources behind optimizing that alpha engine that we can bring to clients.
Are there any rules of thumb or trends that you've noticed with regards to the balance between the two engines, depending on the type of investor?
Yeah, I think with scale, the moment you're beyond a particular size, I think I don't know of any investors who don't try and get engine number two working for them.
Yeah.
Right.
But are we talking 90-10 or 50-50?
Yeah. So I the way I think about it is because, interestingly, capital is actually not a constraint in it. So what constrains you on the alpha engine, right? So if you look at the alpha engine, let's talk about it, because there's two aspects of the alpha engine I talked about. One of them is how do you boost your returns and how do you boost your resilience, right? So let's just talk about both aspects. So you talk about how do you boost your returns. The biggest way to boost your returns in that engine, there's probably I probably talk about. There's an overarching construct, but I'd break it down into three subparts. Okay, so part number one is you have to embrace illiquidity, right? Because the best way to get outperformance is embracing illiquidity. Number two, you have to try and move early into opportunities, right? Rather than being late to opportunities, because there's a supply-demand imbalance where there's capital, there's less capital available than the opportunity is, and so the earlier you can move into certain types of opportunities, for example, specialist lending type opportunities into healthcare and software, etc. So we did a lot of that early in the cycle. We went into private debt about 13 years ago before it became a formal asset class. So if you can move in earlier into certain types of opportunities, you have the ability to capture excess returns, right? So it's sort of illiquidity, move early. And then the last thing, which I think is increasingly important, is the partnership structures are critically important, right? So for us, given our scale, we're able to structure partnerships with our asset managers, which are not high fee partnerships necessarily, right? And so you can structure them as separately managed accounts, and co-investments become a really important part of structuring those relationships effectively.
So, so two of those three drivers. So the illiquidity aside, which is more of a kind of a conceptual choice, but getting in early and kind of getting these what would you say, advantageous positions, they both require you to be really in the loop. You've got to be, you've got to really and you've got to be confident in your own analysis of the situation, because you're not following anyone. You're assessing things on their own merit. So you're having to earn your money.
Yeah, I mean, absolutely. And that's our business, right? We've got 380 people globally, 160 people are in the investment team. We're organized by broad asset class. So, we don't believe in very strict asset class labels. So we're broadly sort of split into illiquid and liquid asset classes. But we've got a overarching investment committee that looks across all opportunities, because we want to be very alert to dislocations happening. For example, in healthcare, we've invested across the spectrum, liquid, illiquid. And so that sort of lens we think is important as you're trying to optimize returns for your clients, right? And trying to create the right structures to invest in certain types of opportunities. So you can only move early, I think, if you're set up in the right way.
Yes. Yeah. So how does that actually work in practice? You don't have let's say a private equity team that thinks healthcare is hot right now.
Yeah, we would say we have a very dedicated private equity team, which is entirely focused on building and accessing great relationships and assessing the market, saying right now, these sorts of opportunities look very interesting, right? Like we think sort of complex, sort of special sits looks very interesting in Europe at this point in the cycle, for example, right? So there's that view that comes in for the private equity term, but there are times when we sort of say, look, we think there's a paucity of capital. Let's take software and the overall tech industry. So we have sort of COVID, then we've got a big sort of decline in valuations in the sector. A lot of the companies do not want to raise dilutive equity financing, right? So great opportunity to step in and provide debt, right? And sort of capital solutions to that sector. And so, but if you don't have a wide lens and work out that actually, the opportunity here is really around providing financing in a different way. And so we'd partner with asset managers who are very explicitly focused on that opportunity set. And it's a great time to do it, right? So unless you have that sort of, it's not like we don't have dedicated teams by asset class, but we're constantly stitching them together. And we don't have silos, right? We don't have silos, and we've got, we're constantly looking across the asset classes to.
So how big are you internally? Because presumably that you can pull that off if you're of a certain size, but eventually you become bureaucratic and siloed no matter what you do, maybe.
Yeah, I think you would argue that if you've got the culture to fight hard against it and you've got the setup, I don't think you need to become that, Ross. I mean, my view is, because we have 20, 25 people in each dedicated team, but the incentives are not around deploying as much capital as possible, right? The incentives are very much around how do you drive out performance. We have our entire senior team has deferred compensation invested in the underlying vehicles our clients are invested in, right? So everyone is focused on how do you make sure we drive performance for our clients, right? And so the incentives are structured in such a way that it is aligned towards doing the right thing for your own capital and for the clients, rather than sort of saying, look, for my own career advancement, I need to deploy the extra dollar in private equity rather than private debt, right? I mean, that's kind of not how we're set up.
Yeah. But given your long-term focus and your endowment model, those incentives will be long-term as well, I assume.
Yes. They're locked in and they sort of roll over periods of time.
As is carried interested as well in a normal situation.
Yeah, exactly. Yeah. So, I mean, one other aspect I'd like to talk about, because I talked about in the alpha engine, we sort of have the return piece we've talked about, which I think is critically important. But there's also the resilience piece. And so when you go to sort of engine number one, the beta engine, you can't access hedge fund sort of exposures, right? You can't access absolute return sort of exposures. And while there was a big push about 10, 15 years ago to try and sort of create very liquid hedge fund type exposures, we just don't think it works, right? We just think it's not the right construct for it. So a lot of the world doesn't quite know how to fit hedge funds into this whole equation, right? And we have a very clear view on where hedge funds fit in, right? We think the way where you have to think about hedge funds, particularly what we call absolute return funds, is as an alternative safety net, right? So right now, when think about sort of returns, we've talked about returns. In resilience, what do you do for a safety net? What do you do to create a resilient portfolio? Some people invest in government bonds. You sort of have gold, which does well when everything else does poorly. You have other sorts of assets which sort of seem quite stable. You'd argue some types of infrastructure assets provide that, certain types of core real estate provide that sort of exposure. In our view, absolute return should be part of that consideration set, right? Because if you look at the data, it does 300 to 500 basis points over cash over cycles, which is extremely valuable when you think about it at times of crisis, right?
Well, so the absolute return hedge fund strategy as a sector outperforms that much
Yeah.
in general,
Yeah.
like,
So
as
if
an
it,
average. Or
yeah, as an
median.
average, and it has very low volatility. If you construct it well, it's a very
What does that look
stable-
like? I know nothing about hedge funds, and I
Yeah.
suspect, even though they're very sophisticated, a lot of my private equity viewers may know little.
Yeah.
So, what is that typically? How are they getting that outperformance? And what's the diversification and correlation? What instruments are they in, and what risk premium are they looking at?
Yeah. So they are the way absolute return hedge funds work is usually there's a group of strategies that are put together where they have very little correlation to the broad markets, right? So they're trying to take the economic cycle and the broad markets out of the equation. And they're sort of saying, if we neutralize a lot of these other factors, can we pick up excess performance? So, in effect, what they're trying to do is they're trying to pick up pricing inefficiencies. They're trying to pick up returns from skill, right, rather than returns from beta. And they're trying to package it, and they will use leverage, right? They will use a fair amount of leverage to amplify the inefficiencies, right? And so that's essentially how they work. And you have to put it together. Portfolio construction is critical. You have to diversify across different types of strategies. A lot of it is arbitrage. For example, they could be playing different sides of a fixed income curve because there's an inefficiency there. They could be playing different currency markets. They could be simply doing long short equity investing where they're sort of saying, I like this company more than that company, but I'm going to buy the company I like and I'm going to sell the company I don't like. But it's in the same sector, therefore I'm neutralizing the broad market exposure. I buy auto company X and I sell auto company Y, but I neutralize that, but I pick up the spread, right?
Yeah.
So it's a skill game. It's but you have to put it together very effectively. But if you do it well, and we've done it for long periods of time, you can pick up a good amount of outperformance over cash. So then, if you're not worried about liquidity, you'd say, look, I'll put some money in cash for my safety net, but I'll put some in government bonds, which, by the way, you can access through engine number one because it's very liquid. But actually, I could put some in gold, which I again get from engine number one. It's liquid. But I could also put some in absolute return, and it just creates more resilience. Right?
Presumably, there's a huge dispersion of returns within those absolute
Huge
return
dispersion,
funds.
not as much as venture capital. So if you look at the dispersion, when you look at the dispersion of returns, it is huge, but the dispersion is a bit tighter than you look at it. So private equity and venture capital have even more dispersion of returns,
really, than the hedge funds.
Than the hedge funds. But the hedge funds, I mean, I suppose we look at it. We look at a certain type of hedge fund, not a long only equity fund, which has got a little bit of shorting, which sort of pretends to be a hedge fund. Right? So it's sort of, we have a very clear definition of what it is.
Yeah. And so you look at venture capital as well as part of the mix.
Absolutely. We look at venture capital, we look at real estate, absolutely everything.
What about how involved do you get with the tax efficiency of the portfolios?
Very involved, Ross, because 40% of our base are taxpayers, right? In the US, in the UK, and other parts of the world. And so we're very involved with thinking through tax. And we've set up specific structures to make sure that it's tax efficient for our clients, right? And so for the US, we've got a big push to make sure there's very clear tax efficiency for US taxpayers. In the UK, there's things like reporting status funds. So a lot of our liquid vehicles have reporting status to make sure that it's efficient for UK taxpayers. So it's a big part of what we do.
I don't know what reporting status means.
It's
I feel like I should because I'm in the UK.
UK. It's essentially where if you are offshore capital gains will get treated as income in
By the
UK
Treasury.
tax parlance, unless it's in a wrapper called reporting status. But if it does report, then actually you can roll up tax and you don't get taxed on offshore
Right.
capital gains as income, right? So it's just technicalities, but it is very important, right? Because one of the spokes of our endowment approach is, so if I just lay out the spokes, one is the right portfolio building blocks, which we've kind of talked about.
Yeah.
The right managers, the right partnership structures, being early into the right types of relationship, and the last one is all about sweat every basis point, right? Which is, it's not like investing in broad liquid markets and buying ETFs where actually there's very low friction costs. If you want to really do this, you got to make sure you get it right, because otherwise you'll end up paying high fees, right? So getting the wrappers right, making sure that you're not leaking money in terms of poor execution is actually critically important. We think it adds 50 to 100 basis points to returns if you get it right.
Managing the details always matters.
Massively, yeah.
So you say that you want to get in early. I just want to go back to this point. So it's one of the pillars of the alpha engine is you need to get in early to make sure that you reap the benefits of whatever innovation's coming about. What is new that you're looking at that you like the look of? Is there anything out there at the moment? The new private debt or,
Trade secrets, Ross.
Oh, yeah, well, exactly.
No, I'll give you one or two examples which are a little more recent. Litigation financing is something that we went into fairly actively about 8-9 years ago. And it went through a bit of a J curve, not quite doing what we wanted to do, but actually it's starting to come into its own now. And so we were very excited about what that's doing for us. But it's pretty uncorrelated, right?
Yeah.
There are other areas in healthcare that we've looked at very carefully, things like drug trial financing and other types of opportunities where we are deploying a decent amount of capital, because those will kick up the returns. The areas that we're most focused on right now are things like digital infrastructure and energy transition, right? Where, let's take energy transition. I think there's a huge opportunity set out there. So we want to get in early, but equally, we got to be quite careful about how you play it, right? Because you could, there's going to be tons of winners and losers coming out of it. And so we don't want to rush in. But it's very clear to me that there is a real opportunity set emerging in energy transition. I don't think people have quite cracked how to play it effectively yet. But it is one that we will be very focused on in terms of finding the right ways to get out performance.
Yeah. My money would be on mini nuclear. That's my thing.
Okay.
I wouldn't have the first clue how to play it. But
you think that's an interesting opportunity? Well, yeah.
Well, I just think that, the obvious stuff is done and actually doesn't work that well anyway. So,
yeah.
So what do you think the kind of the general impact of the advanced endowment model? What is it? The advanced endowment approach is having? Are you achieving that? I mean, kind of David Svensson, the Yale stuff. That's kind of legendary status now. But I mean, even some of the big, like Harvard's alternatives performance has been pretty actually underwhelming of late. So even the big ones can not do so well over time or not be that consistent. So the advanced endowment approach, are you starting to deliver that type of legendary Yale status for just a family, decent sized family office or a small European like startup endowment,
Yeah. I mean, I think our mission is to make sure that smaller endowments, foundations, or investors can deliver US endowment style returns, right? And our track record says we can do it, right? Having said that, the last few years have been tricky for, as you said, for whether it's a big, small endowment or our clients, it's not been as easy to generate our performance, right? Now, I'd put that into two camps. Let's talk about the liquids and let's talk about illiquids. On the liquid side, our hedge fund portfolio has done well, by the way. So absolute return has been fine. But if you look at liquid equities, um, it's back to my diversification point. The gains have all been very concentrated on sort of the Magnificent Seven, as you would have sort of read. And therefore, it's been very difficult for active managers to outperform, right? Because of such a concentrated, such a narrow industry area. That's starting to change now. And so we're starting to see some of the outperformance come back within equities. So it's been
driven from elsewhere.
They're driven because the Mag 7 have not, you've seen a broadening out of performance, right? And so that's started to help in terms of active management. It's been a tricky, environment to outperform. So again, back to engine number one versus engine number two. Engine number one has been just fine. In fact, better, right? On just the equity side.
Yeah.
Right. So it's not been very
because
beneficial.
The Magnificent Seven is such a staple of the beta. It's hard. The bar's been raised for the.
Yeah.
Okay,
I mean, if you look at things like the S&P 500, and traditionally you'd compare the cap weighted index, where the Magnificent Seven dominate, to the equal weighted index, saying if you just weighted every stock equally, then what would that look like? And the difference between the two is very stark. Yeah. Right. So there's about 500 basis points of difference between the two, right? Which it's never been this stark. Yeah. Right. So that's been a headwind, right?
Yeah. But just to be clear, though, the endowment approach, it's not done badly. It's just that it's hard to get
outperform.
Right.
I'd almost sort of say engine number one, by the way, is done just fine.
Yeah.
But has the engine number two, this expensive engine, has it actually delivered? And
right.
You'd sort of say over the last 3 years, it hasn't.
Right.
Right. And so that's the question, right?
But this is the illiquidity point, isn't it?
Illiquidity, it's equities, if you've got active equities in there, it hasn't sort of outperformed. So, there's questions on, that's why there's questions on, actually, does this approach work anymore? And we firmly think it works. And by the way, the resilience point is missed by many, right? Because they're sort of saying, you're just looking at it as equities, bonds, etc. But actually, you're missing the point that there's an underlying resilience from diversification that just you don't look at when the numbers don't look so good, but actually, it's hugely important.
And also, the people selling alpha never tell you about the defensive qualities of what they're offering.
Yeah, because they're selling hope of outperformance. They're not sort of saying actually the quality you're getting.
Yes, exactly. Yeah.
And the defensiveness is a crucial part of it, right? Yeah. It doesn't sound as fun to sell,
cool.
right? It's just boring. Yeah. So the liquid side has been tricky. On illiquids, it's been a question of marks, right? So over 5 years, you look at over the last 5 years, private equity, private debt have still delivered premium returns, right? Even historically. Now, and if I was just looking at the underlying data, if you look at the actual earnings that have come through from private equity firms, the earnings have been just fine, right? The earnings have been fine on the sort of the underlying companies that private equity owns. What's actually happened is there's been multiple contraction, right? Yeah. So you look at sort of private equity, you look at the underlying earnings have been great. They've been just fine. So businesses are doing fine, but they've, at the end of 2021, et cetera, the multiples were just elevated. So the deals done at the end of 2021 are definitely done at a multiple that they had to pay given what the market was. And that you've seen that compress, right? So that's what's really muted the returns relative to public markets. And obviously the public market multiples have re-rated. In private equity, they haven't re-rated.
Oh, there's an opportunity there.
There could be an opportunity, right? But I mean, the interesting thing is on a forward-looking basis, you sort of look at private equity and say, so is it dead? We think, no, it's totally alive as long as you're investing in the right parts of private equity, where they're much more focused on earnings growth. And while the IRRs might be diluted, right? Because I think there's, companies are going to take a couple of years to grow into the valuations that were paid in 2021, right? We think the fundamental model is intact as long as you're working with the right types of private equity firms in the lower mid-market. We actually think, the long-term outlook for private equity is very strong.
But if it's just a multiple derating thing, this is ameliorated if you are investing through cycles across vintages.
Exactly right. So that's exactly right. So you might have 2021 vintage a bit sort of hit. And in our space, because we did a lot of lower mid-market and specialist private equity, actually the multiple derating has not been big, right? In the large cap private equity space, where we don't have much capital invested, we think it's just more efficient. There's been more derating, right? Because clearly they've had to pay bigger multiples for the large cap buyouts. But the small mid cap buyouts, I actually don't think has been particularly affected. So we're seeing much more resilience in terms of returns in that
So you
space.
like the smaller end of the buyout market?
Yeah,
Yeah.
definitely. We just think
Yeah.
it's more inefficient. We think you get industry specialists, and we think the operational value add that you get from specialist firms operating there, we think is going to really drive our performance. Because if you think about private equity, sort of three key levers of outperformance, there's sort of buy low, sell high, which is just multiple arbitrage. There's leverage, and then there's sort of earnings growth. And buy low, sell high, tricky to achieve in this environment. Number two, cost of leverage has gone up, right? And yes, it might be moderating, but given sort of changes in the market and given the election in the US, we actually don't think interest rates are coming down that quickly, right? And therefore, that's going to remain tricky, right? Historically, it's been great for private equity because the cost of leverage has been so low, but not that easy. And therefore, you're left with those two levers have sort of not really helped. What about earnings growth? And therefore, we're very focused on earnings growth. And if you have the lower mid market private equity firms very focused on driving earnings growth and sort of post acquisition value add, and they've got a clear playbook to do it, and they've demonstrated that historically, that's where we want to be investing. And that's basically been our strategy for 15 years. But that strategy over the last 15 years has not delivered outperformance. It's been great relative to public markets, but it's been in line with the broad large cap buyouts, right?
Yeah.
But again, my point on resilience is that yes, it's been fine historically, but actually it's a lot more resilient now. And going forward, given the levers I talked about, I actually think it's a much better space to be in. We've said that for 15 years. It's taken 15 years for it to actually start playing out, but we firmly believe that that's the area to be in.
Well, let's try and make a few forward-looking statements.
Okay.
So one might be around, so it's been a difficult few years to achieve alpha. I wonder what your view is for the coming, 3 or 4 years, and also about Partners Capital itself, and your ambition, strategy, aspirations for doing what you do and potentially growth.
Sure. On a forward-looking basis, we don't see any reason on a 5-year basis. By the way, there's been outperformance, right? On a 3-year basis, it's been tricky, right? On a 5, so you sort of extend it to a sensible, in our view, you need at least 5-year cycles to think about it. We think it's been fine, and we think it's gonna continue, right? But as long as we are continuing to dig deep and trying to make sure that we are following the various spokes of what we consider important in terms of not just identifying the best managers to work with, but also striking the right partnership structures, stitching it together effectively, we think there's no reason why that can't continue. And on the liquid side, it's clearly a more efficient market in on the liquid side relative to private markets, right? But there is some outperformance available, right? Even in equities, and it's been a tough period, but there's no reason why dispersion doesn't start to come back and you start to have some ability to outperform. So on a forward-looking basis, clearly most of the outperformance is going to come from illiquids, but we're not, we think there's some from the liquid markets as well. So we're pretty optimistic on a forward-looking basis. There's no information out there that tells us it's going to become disrupted completely.
Yeah.
On Partners Capital itself, we essentially take on about $3-4 billion of new capital every year, which is digestible growth from our standpoint. About half of that comes from existing clients, and about half of that is from new clients we take on. And our mission is just to keep it going, right? And a really important point that we're all very focused on is to continue to innovate and to use scale to our advantage, right? Because with scale comes some real benefits to be able to drive structured partnerships and sort of ways to access themes that you can't do when you're much smaller. And we're just very focused on doing a lot more there. For example, in a lot of the hedge fund exposures we've created managed account platforms where it's much more capital efficient for us to run certain types of absolute return exposures. So we're constantly innovating to try and make sure that we're sort of, taking the cost out of the equation, right? Which which is, it's the only guaranteed source of alpha, right? You take cost out of the equation, it immediately
get efficient,
drives out performance. Yeah.
So I think I understand now why all these private equity guys trust you with their money. I can imagine them going to a private bank, and they're oriented. They might have a lot of private equity exposure, but they want more. They just want it in a more diversified way, and they want someone that speaks their language, that understands alternatives, that understands the true value of an illiquidity premium. And you get all that. You really do speak the language of this market, but in a way that brings so many other skills to bear. So it's been really fascinating speaking with you, and good luck with what comes next.
Great. Thank you, Ross. Thanks for having me.
You've been listening to the Fund Shack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.